Welcome to Spiedel's California Minute. I'm your host, Catherine Zidane. This week, we're covering some key California nonconformity issues for 2023 returns. There are still a few in-person seminar and live webinar dates remaining for Spiedel's federal and California tax update. Sessions run through the end of January, but dates are selling out, so to get registered, visit caltax.com. Anyone completing California tax returns will need to navigate California's nonconformity minefield. Nonconformity is generally due to two key factors. California has chosen not to follow specific areas of federal law, and other than certain areas dealing with retirement plans, S corporations, and filing status, California does not conform to any federal law passed after its specified conformity date, currently January 1st, 2015, unless a specific law conforming to the new federal law is enacted. Although California automatically conforms to federal retirement plan provisions, including required minimum distributions, these automatic conformity rules do not extend to whether contributions are deductible. This means California does not currently conform to the Secure and Secure 2.0 Act's increased deductible IRA and qualified plan contribution limits. If California does not enact conforming legislation, taxpayers will only be able to claim deductions for the pre-Secure Act deductible contribution amounts on the California return. For individual returns, some key nonconformity issues include the following. California does not tax Social Security benefits or unemployment benefits. Alimony continues to be deductible by the payor and taxable by the recipient for California purposes. California has not conformed to the TCJA limits on mortgage interest deductions and the repeal of the deduction for home equity loans. Moving expenses are still deductible as an above-the-line expense for taxpayers subject to California tax after the move. California does not recognize HSAs, so contributions to HSAs are not deductible for California purposes. Other Schedule A deductions, including unreimbursed employee expenses and casualty losses, are still allowed on the California return. Domestic and foreign income taxes are not deductible on the California return, and California phases out itemized deductions based on 6% of federal AGI. For business tax returns, some key nonconformity issues are that California does not conform to the federal bonus depreciation deduction. It limits the IRC Section 179 expense deduction to $25,000. And has not conformed to post-2024 depreciation changes. The excess business loss deduction is handled differently for California and federal purposes in several ways. California does not have a business interest deduction limitation. Unlike federal law, taxpayers who receive employee retention credit refunds can, for California purposes, deduct the wages on which the credit was based. California NOLs are not limited to 80% of the taxable income, and California does not allow a 2-year carryback for farming NOLs. The employer's deduction for meals provided for the convenience of the employer is not limited by California to 50% of expenses. Deductions for business-related entertainment are allowed for California. California imposes the AMT for corporations and does not allow an acceleration of AMT credits. And California does not allow a dividends received deduction. In the January 2024 issue of Spiedel's California Tax Letter, we have a full discussion of California nonconformity items, including nonconformity regarding U.S. government obligations and depreciation differences. For information on subscribing to this monthly newsletter, go to caltax.com and click Publications. That's all for this week. Join us next time for another episode of Spiedel's California Minute.